Hello guys, welcome to lesson 4 of 2.8 Finance, which is calculating the effect on saving and borrowing of changes in the rate of interest. So by the end of this topic, you can see from the bottom of the box there, the syllabus requirement. The learning outcome is to be able to calculate the effect on savings and borrowings of changes in the rate of. So we take an example. Sam borrows £5,000 to buy a car and is paying an annual interest rate of 3%. How much is the annual interest payment? Pause the video and we'll see if you're correct. So hopefully you are familiar with how percentages work. Percent means out of 100, out of 100. So in order to calculate the annual interest payment, what we do is we take £5,000 and we multiply by 3 and then divide by 100, because 3% means 3 out of 100. So £5,000 multiplied by 3 divided by 100 is £5,000 multiplied by 0.03 on your calculator, which should give you an answer of £150 interest that Sam has to pay. Okay, next question. Suppose the Bank of England cuts interest rates, leading to a fall in Sam's annual interest to 2%. How much less interest would Sam pay? Pause the video, have a go, and we'll see if you're correct. So again, 2% means 2 out of 100. So the amount of interest that Sam pays is £5,000 times 2 divided by 100, which is £100, which means the answer to the question, how much less interest would Sam pay? Sam is now paying £50 less interest, because it's £150 in the first case minus £100 in the second case. So Sam pays £50 less interest. So what we can hopefully see here, what we can conclude from this, is that lower interest rates benefit borrowers, because the interest paid on borrowed money falls. So we'll take another example here. Tessa has savings of £15,000, which is paying her an interest rate of 6% per year. How much is her annual income? Pause the video. So hopefully we're getting familiar with this now through repetition. So 6% means 6 out of 100. So the annual interest or income is £15,000 times 6 divided by 100, which gives us an answer of £900 of income. So the second question, suppose the Bank of England raises interest rates, leading to a rise in Tessa's annual interest rate to 7%. How much more interest would Tessa earn? Pause the video and we'll see if you're right. So 7%, 7 out of 100, £15,000 times 7 divided by 100 gives us £1,050. So the answer to the question, how much more interest would Tessa earn, is Tessa is earning £150 more in interest than in the first case. So hopefully we can see the conclusion here is that higher interest rates benefit savers, since the interest earned on savings rises. And of course, the reverse is also true. Lower interest rates do not benefit savers. So recently, when the Bank of England announced a cut in interest rates in March due to the coronavirus, this meant that savers lost out. So many savers will have got a letter home saying, following the Bank of England's interest rate, we have cut the interest rate on your savings account. So when the Bank of England cuts interest rates, the other high street banks tend to follow suit. So they will cut the interest on their accounts. So you will find, if you have a savings account, generally speaking, that when the Bank of England cuts rates, you will receive less interest. So having now looked at the effect of changes in interest rates on savers and borrowers, we can now finally answer the question, how do banks make profit? So what banks do, high street banks, is they tend to set borrowing rates higher than savings rates. banks' borrowing rates tend to be higher than savings rates. So, for example, if Bank A has deposits of £100,000 and pays 1% interest on those deposits, and let's suppose that Bank A also makes £100,000 of loans and charges 3% interest on those loans. So in this simple example, how much profit does the bank make? We're assuming here that there are no fixed costs and that the costs are purely in terms of the interest that the bank has to pay out on the deposits. Of course, in the real world, there would be fixed costs, but profit equals revenue minus costs. And if we assume away the fixed costs, then the profit is the £3,000 of revenue minus £1,000 costs. So the profit in this case is £2,000. We could make the example more complicated and say that the bank has also £1,000 of fixed costs. And if we add that to the other costs here, we would find that the bank would still make profit of £1,000. So even though we assume away the fixed costs, the example is still relevant. Banks tend to set borrowing rates higher than savings rates, and that's one of the reasons, the main reason, why they tend to make profit. So at the moment, with current interest rates in the UK being very low, you would struggle to get interest rates higher than about 1 or 2% on your savings accounts. But if you get something like a personal loan, a bank will charge you a higher interest rate. They will tend to charge you maybe 5% or 6% interest. If you take out a mortgage, which is another type of loan, when you buy a house, the mortgage might be, say, 4%. The mortgage rate might be 4%. And that tends to be higher than the rates that banks will give you on savings accounts. Okay, so hopefully you have absorbed those points and been able to do those calculations. Once you've done the notes on this topic, try the questions on the next slides, and I will see you for the next lesson.